Welcome to the Real Estate Industry Update. I'm your host, Daniel Riccati, here with Kyle Paxton, back for another video. Today, I think it's a very timely topic. We're going to talk about deploying capital in a slow market. And if anything Kyle and I have heard from our clients over the last year or two, it's that this is a really slow market. There just doesn't seem to be any deals, basically a deal desert, okay? And when you're dealing with real estate investors, like that's a problem. They're always looking for the next deal and they're just sitting on all this cash and dry pattern because every deal feels either overpriced or underwritten. And if you feel the same way, you're not crazy. Everyone feels that way right now.
Yeah, we're always looking in the past on the tax side. And in preparing the 2025 tax returns, we have our groups that, have a whole bunch of syndications, whatever. And it's funny, there's just not that many new entities coming through this year. It's interesting how that works. Nice correlation there. So yeah, let's dive in a little bit, Daniel, and talk about this and different sources of funding and, ways to navigate this slow market here.
Yeah, I just think people need to realize like the market's not dead. It's just slow. All right. Clean deals, they're sacred right now. It just seems to be a lot more messy deals.
Yeah.
But that doesn't mean you're out of options. All right. So let's kind of define like what is this deal desert we're
Deal
going through?
desert. Dun dun.
All right. Yeah. It doesn't mean that there's zero opportunity. It just means that there's some friction. All right. And there's three main types of friction right now. Pricing friction. Okay. This is basically sellers are anchored to yesterday's valuation. All right. They want that price that they were going to get back in 2021. All right. It's hard for them to sell something lower when they knew it was worth more a few years ago. I mean, that's just common human emotion, right? Doesn't matter if you're at the commercial real estate space or you're just a homeowner, right? It's hard knowing that your house was worth more a few years ago and you're not getting those same pricing. So pricing friction is a very big deal right now. Next, financing friction. All right. So lenders, it's tough to get financing right now.
Yeah.
All right. One, you're used to those interest rates a few years ago that were much lower, several percentage points lower. And so you're looking at today's interest rates and you're like, I'm looking at maybe even a double digit interest rate sometimes, high singles or something. And so it's when you're seeing interest rates like that, and then lenders are just tightening. I mean, they want much better yields, okay? And they're willing to give you a lot less. So that's when they're not willing to give you as much, interest rates are high, just makes deals more difficult. And then lastly is the timing friction. I think this is the one that sometimes goes a little bit unnoticed, but the reality is that it's taking longer to do anything. All right. Longer for a deal to go through, longer to refinance, longer to sell the property, longer to just find a lease, longer to do due diligence. And so when deals take a longer time, they just have a more difficult time to pencil. All right. You got carrying costs, you have many other things like that. And a lot of these deals, when you add 3 levels of friction, now it feels like there's no good deals out there.
Yeah, and Daniel, I'm seeing a lot when you're entering this financing space right now. Your reporting's got to be tight. I'm seeing tax returns get scrutinized in more detail by bankers. I'm seeing those personal financial statements torn apart. The disconnect between a personal financial statement and what's reported on the tax return. So having really good reporting around your cash flow and understanding how all of your reporting ties together to paint the picture of cash flow is super important in this quote unquote deal desert market here.
Yeah. I mean, I think, back in 2021, you could buy these deals and, they would be thin, a ton of cash flow, and then the market just bails you out. You can't do that anymore. All right. Now we're in 2026. The market cannot bail you out anymore. And so it really takes skill and talent. Yeah. As a real estate investor, when you're going into these deals, you can't just buy something and it's going to work out. So it really is like, this is testing all our real estate investors out there. Are you really that good of an investor? If you can succeed in this market, then you can succeed in any market. It's just, we had a really good from about 2012 after the huge 08 recession happened. It's been basically, the market's been going up since 2012, from about 2012 to, I would say, like 21, 22, somewhere in that area. I'd say 22 is probably is when it started really going down. You almost couldn't mess up. Okay. And so now it takes an extra level of skill to make sure your deals are working. So let's go into some of the biggest drivers here, maturities and margins. And so what's happening right now with some quick marketing context? Okay. So Mortgage Banker Association shows that in 2025, about 20% of outstanding commercial mortgages were scheduled to mature. Okay. So one in every five was going to,
And
was
we've seen
basically
it.
right. And then scheduled to mature in 2026 is another 17%. So you're talking about almost 40% of all mortgages out there are basically going to need to get refied in 2025 or 2026. This is a huge wave. Okay. It doesn't mean that deals are dead. It just means that we're in a place now where you might have gotten those really low interest rates, really cheap financing. And now we're in an area where, hey, I'm not getting that. How is that making my deals pencil, basically?
Yeah, and Daniel's mentioned this before, but we're really seeing this is the time frame that really separates the savvy real estate investors from the not so savvy real estate investors. And if you are entering this space as a limited partner or looking to finance one of these real estate operations, it's extremely important to vet the operators and understand how savvy they are in this space and finding the right tools to do that, because we are really seeing that divide on investments that were entered somewhat haphazardly in the anyone can make money environment into now just the more creative financing needs and cash flow planning is, we're seeing more separation there.
Yeah. And I want to report, like, deals are not dead.
Yeah.
In Q3 of 2025, they're still reported $150 billion in commercial real estate transactions. So there's still a significant amount of deals out there. They're just not getting the numbers you used to. So let's get a little bit more tactical now, Kyle.
Yep.
All right.
Let's do it.
So how should underwriting change when deal flow is sacred?
Yeah, absolutely. So I want to reset the base here. The cash flow durability beats pro forma optimism. And you really want to stop asking, can I hit my RR, and start asking, can this asset self-fund its problems, right? And so this is where, again, this is so important for survival. So really what we're looking at is exit cap discipline, debt stress testing is non-negotiable through this process. Making sure we have timeline stress. If you are intending or need to hold longer, you have a slower lease up or stabilization or a lower sales process, you have to be ready to do that. The model expense realism. This is huge. We operate in Florida. Insurance is really, really high. Property taxes are a hot topic and high. And so you want to make sure that you're modeling those big ticket items correctly. We see it in the accounting industry. It's across the board. Payroll costs are only going up, and that doesn't necessarily fluctuate with the markets. And the same deal as repairs, right? Depending on what type of assets you're entering here, we're seeing those costs just continue to go up and up. So making sure you're modeling around your expected expenditures and unexpected expenditures in a realistic way is huge. And then kind of tied in with the repairs, CapEx and reserves, making sure that you have the cash flow or the funding set aside to where you can make those improvements that you promised your investors, whatever it is, to bring rents up to market rates and really maximize your investment.
Yeah, I think people really need to understand here is that when your job is not just buying a deal, your job is to make sure the deal survives the next 24 months. It's not begging for mercy. All right. Your deal might work now, but is it going to work in a couple of years? And so in today's environment, underwriting is all about probability weighted outcomes. Okay. So when you are doing your deals, you really want to make sure you're tightening your exit and widening the range. Okay. So stop using this single exit cap. You need to start having two different ones, a base exit cap and a defense exit cap. All right. If deals only work in a best case scenario, it doesn't work. You need to make sure it works. If the market got worse in 2 years, no one knows what the future is going to hold. But the reality is, in today's market, it could get still worse. And so, does your deal still work in this worst case scenario? It can't be all optimism. I mean, I'm a very optimist guy. I want to think for the best. But when you're really buying a deal here, you almost need to go the other way and say, hey, what's worst case scenario? Because if you're thinking everything will be better in 2 years and the market will again save my deal, that's not a plan. Okay. And so what happens when you need to refinance and interest rates went up again? Okay. That's a real problem right now. All right. Or is your deal still going to pencil if that happens? What if I want to exit in 5 to 7 years and I can't, and I got to exit in 10 years? Okay. Because the market's just not a good time. So are you marketing this slower time? That's more carrying cost. Takes longer to get this refinanced. You really need to make sure that you are fully understanding that, hey, what's my worst case scenario here? All right. And Kyle mentioned it, but be conservative on your expenses.
Yeah.
Insurance, taxes, always going up. I haven't gotten a property tax bill that was lower than last year's. I don't know, maybe Kyle, maybe it's happening for you,
Nope.
but I've never gotten one. So be honest on that stuff. Like, there's going to be repairs. There's going to be CapEx. Like, be conservative on that. And if it can pencil at a worst case scenario, the reality is that's probably going to be a deal worth buying, even in this market.
Yeah, absolutely, Daniel. So let's get into a little bit creative structuring and talking about what we see in that space, because I'm seeing more and more different types of financing come through with talking about financing challenges through more traditional means, e.g. banks, right? So one thing I'm seeing quite frequently actually is seller financing. And really what that is it's a price cap solution. The seller wants a certain number, buyer can't make a number work with their bank leverage. So all of a sudden the seller becomes part of that capital stack. And there's plenty of reasons why a seller would want to do that. Often it comes from, I have a lot of conversations around this from the tax side on saying, hey, if I do a seller financing deal, I don't have to pick up all that gain in year one. I can spread it out. There's some more tax strategies around that. But oftentimes it works best when the seller has low basis and doesn't need all that cash at closing. The asset is financeable, but today's senior proceeds are light, and the sponsor has like a clear takeout plan or refinance or sell that's going to then get the proceeds back to that seller, right? So I'm seeing that quite frequently in deals, and it allows the seller a lot of flexibility on, recognition of gain, timing of capital, all of that stuff. And so it tends to work out a lot of times on both ends.
Yeah, I've seen a lot more seller financing too.
Yep.
It's just really a good way to kind of bridge that gap right now, with having a hard time finding traditional financing and things
Yeah.
like that. Now, this does take a seller willing to do this.
Yeah.
That's usually just caveat. But sometimes sellers are willing to do it because they're not having a lot of options to sell.
Right.
If it's somebody who doesn't need the cash immediately, not going to turn around and deploy it, sometimes they actually will prefer it because it's kind of like a retirement plan for them, like a pension. Like, I'm going to get X amount of money over a long period of time. And then you can be pretty creative this way and structure, like you said, into the deal and stuff like that. And so this is a really good way if you are a buyer and you're trying to work your deals, like, see if seller financing is an option. You'd be surprised just by asking that it might be.
Yeah, and Daniel, I see this a lot too. This is a smaller scale than what we often talk about, but I have a lot of clients right now who are entering that retirement age. They've been a business owner for a long time and they're selling their small business. And so they have a key employee who's trying to buy the business. There's a building attached to it. The key employee wants the whole operation, the building, and the actual operating entity. And so maybe that employee is having a hard time getting financing due to all the constraints that we talked about. And your business owner who's trying to exit, to your point, just wants that kind of retirement payment over time. And so they're happy to make that arrangement where buyer gets whatever financing they can through SBA, bank, whatever it is. And then they can enter that stack and help with that transition. And a lot of times that helps ease the seller's pain because in that specific example, this is somebody who's worked with you for 15 years. and you really feel good about them performing in the business, and you're optimistic about the business's success going forward. So that's another way that this can kind of look. Um, it's a little different than what we typically talk about, but something that I'm seeing quite often here in 2026.
Yeah, and another one we've talked about before is preferred equity.
Yeah.
Yeah, this is another creative way to make sure a deal works. All right. This is probably becoming so common nowadays. I almost feel like it's not even a creative way. It's just
It's kind of almost the standard more often than not. Yeah.
right. But the right now in this market, we have this gap. All right. It's between the senior debt and it's between your common equity. All right. And a lot of times we got to figure out, they call it the financing debt. Okay. The debt between what the banks will be willing to loan you and what you're trying to appeal with your investors. So we're having to find creative ways. There's mezzanine debt, there's things like that you can get out there, but it's high interest rates. That's just going to make your deal even worse. So preferred equity is becoming more and more popular to kind of fill that gap. And because it's becoming a more popularly tool, though, we need to understand truly what it is, because it can look great, make your deal look great, and then you don't realize when you're looking at your waterfall, like, hey, this could be a real problem. It's going to squeeze your cash in a few years. All right, because you're basically guaranteeing that, hey, you're going to get money first. You're preferring an 8% or something preferred, so you're getting your money first, but you're going to get your return. And then usually it accruals. So like, hey, I might not be able to give you your 8% return the first year or two, until that 8% just keeps accruing. And then it's 8% on top of that 8% accrued. And so it keeps coming. And then so finally, when the deal starts making money, you have to pay these people out first. Okay. And that can basically does some strain on cash. So it relieves pressure, but it compounds. And so the obligation can basically could be a problem, or just needs to be penciled into your deal later on that, hey, these are people I got to pay back, and I'm required in my operating agreement, and it's going to keep compounding until I do.
This is a good time to shout out. We got a whole video on waterfalls. Make sure to go check that out. But yeah, the big thing to look at with preferred equity is really just making sure that it works out from a cash flow perspective. And then, like Daniel said, oftentimes it can accrue, but making sure that you are balancing the preferred equity structures with your common distributions, even if your net NOI is okay for the project as a whole, just making sure the cash flow is actually aligning with the expectations there, and you're communicating clearly around that is key. As we've talked about, I mean, it feels like more deals than not that are coming through right now, pref equity is involved in some capacity. So maybe not so creative in this day and age, but definitely something that should be on your radar in the current financing environments.
I just think if you're not using preferred equity, you need to consider it, just because of the creativity it adds. Like you say, it doesn't feel creative anymore, but reality is it's just a creative way that's really made deals work. Yeah. And so everyone's starting to implement it. Like preferred equity, it isn't bad. Okay. It's just you're trading flexibility today for obligations tomorrow. So just understand what that is.
Yeah. All right, let's jump to joint ventures unless you have anything else you want to talk about there. So, I'll pause. Anything else?
No.
Okay.
Jump in.
Jump in. Yeah. So JVs are how deals happen when oftentimes we'll see one party has the operating platform and the other has the balance sheet or the capital or the fresh equity without blowing up the whole capital structure. JVs are often super common in 1031 arrangements where you have one party who's interested in entering or exiting a deal with 1031s. That can drive a JV structure from the tax perspective a lot of times. And they're common in tight credit environments because the commentary points of high rates and tighter debt, capital partners demand more governance and economic control. And so that's a way that can kind of divide up those roles. Go ahead.
I love joint ventures because this isn't like actually a new concept.
Yeah.
It actually goes back to like old school real estate where you got 20 something year old up and coming. I got no money, but I got time, energy, right? But give me that. I'm going to run their operation. So what do? I need to find someone with capital. So I find the seasoned veteran who could maybe train me a little bit, but they don't want to they've done their time. They don't want to put the time in. They got the money. They want to invest it with you and let you run with it. And so at the end of the day, it's the same model concept. You're just doing it at a bigger level here. And so you're trying to bring in a partner that has money. Okay. But that's going to bring complexities. All right. So when you bring in a partner with money, they're going to want to have a say. They're going to want
Yeah,
to know how much of a say do they even have? How are we structuring this? Because you're really not underwriting the property anymore. You're underwriting the partnership. Okay.
absolutely.
It's really completely different here. And so you just got to make sure if you're bringing in another player for holding capital, really need to talk it through and understand when are they going to get out of here? Because again, you're sacrificing return, future return so you can get cash today, but it might be the only thing you can do to make the deal work. So, joint ventures are a nice way to kind of come back and fill that gap that I feel like a lot of people who first got in real estate,
Yeah.
it's like, this is how I started was joint ventures. And now I'm doing it at just a much bigger level.
Yeah, they ebb and flow over time, but I have seen a resurgence as of late. And it kind of allows, obviously, you just mentioned all the kind of governance points you really have to hammer home, but it does allow a lot of flexibility in the structuring and kind of keeping the sides of the house separate to some degree. There's a lot you got to work out through that.
So I think though, let's kind of jump over here to cash flow.
All right,
I mean, I
good.
think this comes back to,
We
just
never
based,
talk about that.
I know,
Yeah.
this base of deal. All right. And like when you're talking about cash flows and decisions on whether I should buy the property, I'm a big component of if the property doesn't cash flow, find a new deal. Okay. But
Groundbreaking
you need,
stuff there, Daniel.
I, I love real
Yeah.
estate, and real estate has more benefits than just cash flow,
Sure, of
right? You got
course. Sure.
appreciation,
I
you
hear your
got
point.
tax, you got tax benefits, but the reality is, if it doesn't cash flow, you're gonna have a hard time just operating that deal, keeping it going. So you really need to be looking at that property level cash flow and saying, all right, defense first. All right, defense wins championships. All right. We're going like football here and stuff. But so make sure that you're really understanding, all right, if I do a conservative approach here, am I going to have cash flow at the end of the day? All right. Cash is like oxygen to your property. You gotta have it.
Have
All
it.
right. So what's your break even occupancy? What are your collections looking like? All right. Are you looking out what's the next 12 months? Are you doing a 13-week cash flow? All right. It really needs to make sure that if I'm buying this deal, it's going to have cash flow right away. And you're not going to just basically buy a property where you're going to have to put more money in the deal right away, or potentially in a year or two, and it's not going to operate on its own. If a property cash flows, the rest of the benefits you receive, it's just icing on the cake.
Cherry on top, baby. Uh, yeah, occupancy is the low hanging fruit there on just making sure you have a good understanding that. We already talked about expense control and making sure you're modeling around expenses and CapEx are important. So the property stuff is just making sure that thing actually works like you intended. Let's jump to fund level, right? So that changes things a little bit. And this gets back to, we talked about ad nauseum and REIU here of investor relations, making sure communications with our investors is clear. But this comes back to how are we obtaining financing, which is what we've been talking about. What do capital calls look like? What are timing of capital calls if they're needed? How is the communication around them? And then a big one is what distribution expectations have you set with your investors and making sure that you're delivering on those? And so making sure you're tying in these true cash components of the fund level, what the investors are seeing closely, which is cash out of their pocket or cash in their pocket, connecting that with the operations of the properties themselves on an ongoing basis, your big reserve CapEx expenditures, all that, tying that together is key to make a fund successful.
We've said this many times, but it's very transparency with your investors. It's all about clear communication. If you're needing to build your reserve and so distributions are going to be lower, just say that. You need to communicate that as soon as possible and as clear as possible. That's not bad performance. That's actually a good fund
Yeah.
manager. That's a good GP being like realizing, hey, we need to build our reserves. By distributing cash, we're actually hurting the deal and it's going to be worse down the road. So you need to sometimes make a decision that is about the long term, not about right now. A good investor, an experienced, seasoned investor is going to understand that cash today is not worth hurting the overall deal at the end.
The tax trap you want to be careful with here, right, is the classic real estate fund has a large depreciation reduction in year one that has a large taxable loss that's allocated to all the partners. That is a positive for the investors from a tax perspective in that they're potentially reducing their income at the individual level or, whatever entity structure the partners invested in. Great news. The trap you want to run into in years 2 through 7 when you're exiting is, do you have taxable income being allocated to the partners? Because you no longer have depreciation. You have that huge roof improvement you've got to capitalize. You have refinancing, and all of a sudden, from a taxable income perspective, you may not be cash flowing positive, but you have positive taxable income. And now you don't have money to distribute to the partners to pay that tax liability that's being allocated to them. That's a trap that happens and it's not fun.
It's not. And I kind of want to end this with what I think is really important. And that is sometimes holding capital is the smartest decision than deploying it. Okay. Real estate people love to buy, but sometimes not buying is the best decision. Okay. And so holding capital is correct when like the deal only works in an upside case. All right. So back to building out kind of your base and defense models here. Like, what's a worst case scenario? If it has to be a best case scenario for this deal to work, you're just potentially causing a future problem where it's not a best case scenario. And now this deal doesn't work. You need to be planning out, what is the refi going to be like? A lot of these deals, unfortunately, there is going to be a refi moment. All right. No one's getting 30-year fixes on commercial real estate. So what's your plan? What happens if the market doesn't improve? What if it gets worse? All right. So you really need to be structuring this meaningful downside protection here. Okay. And so just understanding that, sometimes not making a deal is actually the best deal you can make.
Yes, sir. And then it gets back to, we beat this to death, but the investor communications. What's your posture? What are the underwriting changes that are coming and what to expect around that? What's your pipeline looking like? What would change your mind in your investing decision? And then what you're doing in the meantime to help make sure that you're positioned for changes and things like that. And I see this manifest in a lot of different ways. I see funds that do like webinar series for their investors where they go through and they run through all this list. I see more passive where they hand you a stack of papers and move on. You got your emails on what's new this quarter. So this can manifest in a lot of different ways, but that communication is key in making sure expectations are clear across the board.
Yeah. And like Kyle, I'm just going to add back onto that, like investor communication is important. So just really be upfront with them. Like maybe we're focused more on our current deals and our cash flow.
Yep.
Okay. And optimizing our current deals. Maybe we're still looking at deals, but none of the deals are penciling. And so we don't want to make a bad deal. We want to be good trustees with your money and things like that. So it's just about being up in front, transparent with your investors of why we haven't invested and why is it important that maybe we actually hold for now and really work on optimizing the deals we have now so we can maximize their returns.
It goes without saying, but I've talked to a lot of investors in the last year in 2025 and 2026 who have entered bad deals and they would have much rather the contrary have happened.
Now, investors get upset when they get surprised and they get bad deals. That's the two things you want to avoid. All right. Well, thanks for listening today and watch our next video.
Have a great day. Thank you.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.